High debt, low wages, overvalued stocks, and in the world's two largest economies, uncertainty. Are we teetering on the edge of another financial crisis? This is Roundtable with me, David Foster. Ten years ago, the rumblings of what would become the worst recession since the Great Depression was starting to be felt. Bad mortgages, bad banks, and economies in freefall. Lessons were learned, but maybe not the right ones.
The worst financial crisis in a lifetime. Multinational banks, over-leveraged, overexposed, and off their guard. One by one, they buckled under the weight of their bad loans, and with them went the world's economy.
Curb the use of tax havens, introduce principles for pay and bonuses. So instead of banks serving themselves, they serve the people.
I urge the Congress to act quickly to address the grave threats to financial stability that we currently face.
The bank's activities shattered lives and livelihoods throughout the country and also around the world.
What lessons can we draw from the last crash to save us from the next? Sparked by a wave of deregulation, a complicated process had been underway for years. The debt of subprime homeowners was being sold on in bundles to other banks. Those bundles of bad debt were then used to underwrite other investments, until the housing market stalled. Thousands of jobs lost, billions of dollars wiped off global stock markets. People lost their homes and their savings. A culture of profit now, consequences later. The financial sector became synonymous with dangerous deregulation. Now economists are asking if we're doomed to repeat ourselves. Low or even zero interest policies have made debt palatable again. Auto loans, credit card debt, student and personal loans have created a bubble. Global markets have climbed to pre-crisis levels. Good news for investors. But some economists are warning that stocks are dangerously overvalued. And there are new variables. US President Donald Trump, leader of the world's largest economy, is an unknown quantity. He wants to cut red tape. He's called current US banking legislation a disaster and believes deregulation will lead to growth. Meanwhile, China, the world's second largest economy, is stalling. Rising debt levels and a downturn in the property market have seen its slowest pace of growth for 26 years. Some estimates put the value of Chinese debt as high as 260% of its GDP. Globally, the aftershocks of the last economic earthquake are still being felt. 10 years of dwindling economic growth has left countries unprepared to weather a coming storm. In the UK, household savings are at a record low, while household debt is at a record high. Financial stress tests in the European Union have shown that some bankers are still holding too many bad loans and not enough reserve capital. Some economists expect the next crash could begin in a quiet part of the economy, somewhere unexpected. History has shown us that complacency is the greatest threat to economic stability. Is enough being done to prevent another devastating financial meltdown?
Joining me at the Roundtable today from Florida, the author of Instability, Booms, Busts, The Fragility of Banks. That's Martin Lowy. To my right, Russell Jones, a macroeconomist and former chief economist at Lehman Brothers. To my left, the economist and broadcaster Linda Yu, and also Simon French, chief economist at the stockbrokers Panmure Gordon. Welcome to Roundtable, each one of you. First of all, this has to be in English, and I don't just mean spoken English, but I mean language all of us can understand, not economists' language, please. And I will correct you if it's something we don't understand. Let me go around the table first of all, and then to you last of all, Martin, with a quick yes, no, maybe. Are we heading, Simon, for another big recession?
Yes, I believe we are.
Linda?
Yes.
Russell?
Yes, it's just a question of time.
Okay, so that's three people who believe it's going to happen. Martin Lowy in Florida, what's your take on this?
Well, recession sometime, of course, but financial crisis, not in the near future, in my opinion.
Okay, why is that?
Largely because most financial crises occur because of cross-border investments, mostly by banks. And it's the short-term borrowings by foreigners that fund the booms that lead to the great busts. And since we do not have that condition anywhere in the world that I can see at the moment, I think we are unlikely to have a financial crisis soon, even though recession can come at any time, especially if we have either a spike in interest rates or a geopolitical event.
Okay, who agrees with Martin's assessment there that conditions have changed, therefore it can't happen again?
I'm a little bit skeptical. I think that the history of global capitalism is a history of financial crises, and to assume that we're suddenly breaking out of that model would be remarkable. I think what we can also say at the moment, what we can also identify is that a number of markets are very overvalued by historical benchmarks. We have very low levels of volatility. We also have in a number of economies very rapid credit growth relative to the growth of those economies, which is always in the past.
So debt outweighing GDP?
Basically, debt growing faster than GDP. In the past, that's always been an indicator that something bad is on the way.
So all the accelerants are there?
Well, I think we're probably unlikely to have a systemic banking crisis, one that brings the world economy to its knees. So we've only really had two of those in modern times, the one in 2008, which I can't believe is a decade ago.
It's hard to believe.
And of course, the 1929 crash, which led to the Great Depression. Now, even in the late 19th century, there was a long depression. So this is the 1870s, 1880s. So I think you can have very deep recessions, but it's rarer to have a systemic financial crisis.
So how are we, as members of the public, rather than as a group of economists, how are we as members of the public going to notice the difference between a big recession and a financial crisis?
Well, I think the difference for non-economists, a solvent profit-making businesses had capital withdrawn in 2008. Was also the case in the Great Depression. A recession, however, you see those that sit on the margins of economic profitability going to the wall, unemployment spiking. This was, and therefore there was a bit more, and you will get that if it is only a recession, you'll get those companies that are probably many economists would say the natural wastage is the healthy way a cyclical economy should weed out those that are inefficient. If we get another one of those, I think that's a healthy part of capitalism. It's very unhealthy to have a financial crisis where all parts of entrepreneurship are penalised from a lack of credit.
You see, Martin, debt is growing worldwide, and an awful lot of people finding that they can't afford to repay the debt because wages are low. It's a very dangerous mix, isn't it?
Yes, it is. But if you look at the facts from a different perspective, if you look at it from the perspective of the amount of debt service that has to be paid relative to GDP, that is actually fairly constant over the last 25 years. And in something I'm publishing this week, I'm using a graph from the BIS, that is the Bank for International Settlements, that demonstrates that. And therefore, I would be more worried about a spike in interest rates causing the inability of non-financial borrowers to continue to pay their debt service.
You see, Martin, you mentioned the Bank of International Settlements, which is called, like, the clearing bank central bank, or the central bank. Now, Claudio Borio earlier this summer from that particular bank said, we are heading towards a financial boom gone wrong with a vengeance.
Well, I respect Claudio greatly. He's one of the best in the world. But sometimes I may not quite agree.
Russell,
I think
you're nodding your head.
You've got to seasonally adjust the BIS, actually. I mean, they're notoriously pessimistic about everything. And Claudio Borio is a very pessimistic human being. That said, I think we are in an environment where interest rates are extraordinarily low, and a big increase in rates would put a lot of companies and a lot of households under huge duress. There is a great sensitivity to an interest rate spike at the moment.
Is it because last time it was all about banks and this time it may not be? It may be about individual debt and things like that? Because Janet Yellen, chairman of the Federal Reserve, also said recently, and we're in a very much stronger position, that is the banks, and another financial crisis unlikely in our lifetime. Is it, as you say, because it was systemic, it was the underlying, it was the foundations of our economy that started to crumble, but this time we might see something different?
Yeah, I think this is that's also quite common to have a financial crisis, have the next one be completely different from the previous one. And so a lot of the regulations, of course, put in since 2008, you know, from Yellen and others, mean that the Western banking system is now more secure, meaning that banks are more regulated, there's more, they have to hold back more capital, they can't lend as much as before. So,
and Mark Carney, governor of the Bank of England, recently told them to do that, you know, to build up your stocks a bit more.
Yes, that's right. So I think in terms of what caused the last crisis, there's been a lot more progress made. But the thing about financial crises is that they're always different in a number of fundamental respects. So
they may be to the economists, but to the people who feel it, they're pretty much the same.
It depends on, so for instance, in the early 1980s, there was a financial crisis in Latin America. Very few people around the world would have felt it. If you're in Latin America, it was absolutely devastating. It had to do with exchange rates. In 1992, the second generation currency crisis actually happened in Europe. And that was when the Deutschmark, to which lots of countries were pegged, that system fell apart, and the UK was in a recession. And then you had the dot-com bubble bursting in early 2000. You had the Asian financial crisis in the late 1990s. They all had slightly different factors, exchange rates, household debt.
I suppose I'm trying to get at what it would mean to people out there earning a wage or not perhaps earning a wage if there is a financial crisis. And the effects of 2008 are still being felt, aren't they?
Yes.
I mean, with austerity in the UK, cutbacks here, cutbacks there. You were partly responsible for those in the UK, and we'll get onto that in a minute if we may, Simon. But that's what's going to happen, isn't it? Jobs?
Look, most financial crises are associated with a significant and rapid spike in unemployment. That's how it transmits through to the person.
Unemployment's good at the moment in the UK.
On the street. Yeah, absolutely. If you look at most G7 economies, their unemployment rates are probably below where their central banks think the natural rate should lie. So actually, things have almost never been this good for the labour market, 42-year lows in the UK.
So what's it going to take to push it over the edge?
So I think for me, it's about geopolitics. We have not diffused the problems that spiked politically in the last 18 months. We haven't diffused them through the political system. And I think it's a risk it spreads to central banks, who we are so inherently relying on. We at the moment have a generation, Carney, Yellen, Draghi, Kuroda, who are data dependent. When you start to get ideologues, and you mentioned the early 1980s, Paul Volcker came into the Fed at that point and went, OK, I'm prepared to spike unemployment in the US to get inflation under control. If you get a similar ideologue replacing Janet Yellen, who may say, well, nominal rates of the US are going to go higher, what is the cost? We don't understand the transmission mechanism into the financial system.
I mentioned at the beginning of the programme two major economies, uncertainty. But that's partly to do with China's growth, which was going up, and still going up, but it's slowed down. Is there a major problem with Chinese debt at the moment?
I think there is, yes. I mean, of course, the $64,000 question is, when does that problem actually translate into a crisis? But I think, and this is very much to Linda's point, the previous crises, when they happened in emerging markets, didn't really spill over to the rest of the world. If China suffers a major trauma, which I believe is probably in the pipeline at some stage, it's now big enough and ugly enough, if you like, that it will have significant spillovers to the rest of the world. And there is no doubt, if you wanted to identify one economy where the growth rate of credit has been running consistently in excess of the growth rate of output for a number of years, it is China. China is going to have some kind of crisis at some stage.
Is it too big to fail, as they said about the banks?
They've got a lot of ammunition to prop it up. There's no doubt about it. But my sense is that China's going to go through
because China owns a lot of America, of course, doesn't it, in terms of American debt. If China's in trouble, it will be felt around the world, won't it?
Yeah, China is too big to fail. It would be similar to the Japanese debt crisis in the early 1990s, when the world's second biggest economy has a massive problem. It's going to have to deal with it internally. The IMF is not going to rescue China, just as it couldn't really rescue Japan. And arguably, there's no need to, because most of Chinese debt is internally owned, domestically owned, just like in the case of Japan. But there will be huge consequences because China is as important an engine of growth as the United States. And so you will certainly feel that in terms of Chinese, not just exports, but also increasingly Chinese imports.
Martin, I haven't forgotten you, and I know it's jolly early where you are in Florida, but could I just ask you a particular question about the United States President Donald Trump and all of this? At this table, they were saying, yes, there are better regulations now, but he wants to wind back, Donald Trump wants to wind back those regulations. What's the danger there?
Well, there certainly is a significant danger, and the likelihood is that most of that will be done via the regulators rather than via Congress, and it will be done simply by softening the approach of the regulators. I'm somewhat heartened by the fact that the administration has appointed a very good person to the Fed who would be in charge of supervision, and that is Randall Quarles. He has an excellent background, trained by some of the best American lawyers in the field, and I therefore have hopes that what he does will be reasonable. The most important part of the new regime is really the stress tests, and I hope that at least that those will be maintained in roughly the current form.
At this table, you are all trained to look out for signs about what might happen. You're all pretty pessimistic about what might happen. So what are you waiting to see next?
An interest rate shock would certainly scare me.
Well, what is an interest rate shock?
A sudden rise in interest rates.
What, by a quarter of 1%?
No, I would say more than that. But beyond
so if they bang them up by 0.5%, 3/4%?
Or a series of surprises, that would concern me.
Yeah, they've indicated that they may well go up, but do you think that is likely?
Yes, I think probably they will. Whether it's the right thing to do at the moment, I think, is another matter. But the signals are all there that the Bank of England, the Federal Reserve, they seem to be firmly established on a path to raise interest.
And would that be the time to do what you've done and sell all of your personal stocks and shares?
Probably,
it's true,
yes.
Isn't it? You
yes,
have.
Yeah. I sold mine a few months ago, yes.
Okay, Linda, what are we watching for?
The most important indicator is how much debt is in the system. And so the difficulty with this is that it's not just the overall amount of debt, it's who owes the debt. So in different countries, it's an issue for different sectors. So if you are worried about, for instance, Chinese debt, corporate debt in China is very high and it's growing very quickly, and we don't know the extent of it because a lot of companies borrow not from the formal banking system, which is state-dominated. If you are worried about household debt, which is an issue, for instance, in the UK, and
so you're talking about credit card debt as opposed to household in terms of mortgages?
Could be mortgages, could be credit cards, could, in the US, student loans are a worry. But none of these are systemic, as in they could trigger a crisis where if you had a housing crash, of course, it's going to really affect you if your house is not worth as much and you lose your job and you can't make payments. So what we tend to look for in academia is at a range of debt indicators and try and work out how much of that would be subject to, say, interest rate rises, making debt unaffordable. And of course, the underlying growth rate is a huge determinant. You can have debt grow quickly, if the economy is booming and incomes are rising, then it's less of an issue.
Linda, one of the things that you said is that, you know, it's not going to be systemic. I think what concerns me in reaching that judgment is that if you go back 9 or 10 years, we had an awful lot of policy ammunition to fire at a crisis.
Yes.
We don't have that now.
Speak English.
interest rates dropped a long way. Central banks brought them down, and they fell, I would say, naturally as well. We're now currently pretty close to zero everywhere. So if we get hit by another shock, we have another crisis, central bank's only option is to do all the unorthodox stuff, the quantitative easing, the buying of assets.
Printing money.
Printing of money.
Yeah.
Governments are very reluctant to use fiscal policy, I would say primarily for political reasons. I think if interest rates are zero, why wouldn't you borrow more? That's my view. So there's an issue with the policy mix if we go into another crisis. Haven't got much room for monetary policy to work, and politicians are reluctant to use fiscal policy. So what counterbalances the downturn?
Well, see, this is what I'm wondering. It swings and roundabouts. It always has been. Everybody says, you know, that we're always going to have recessions of a sort. You know, when interest rates are high, there are people who say, fantastic, I'm getting more interest on the money I've got in the bank. When house prices start to fall, there are always those people who say, fantastic, now I can afford to buy a house. These are things we just have to live with.
Yeah, well, we've had the great recalibration, haven't you, away from savers and towards borrowers as a way to try and reflate the global economy. I mean, I just slightly iterate your initial question, which was what signs are we looking for? We're assuming that central bankers are in charge of interest rates payable on this debt, and that the servicing cost, the chart we spoke about, the BIS chart of the cost of servicing this debt is low. We're assuming that central banks remain in control. We have briefly seen evidence of a buyer's strike in bond markets, quite isolated at the moment. But you talk about China and you talk about the share they own of US Treasuries. You start to see a buyer's strike as a response to domestic and economic downturn in China. Then you see rates starting to hike up on US debt, which translates to real people in terms of their household debt servicing costs, on their mortgages, on their loans. And then the Fed is no longer in control of what the real economy is facing in terms of being able to service that debt. That's what I fear.
I put to you before this programme, Simon, that as somebody who was an architect of the welfare cuts and the austerity measures brought in by the British government, at the same time as seeing record low interest rates, there was an irresponsibility there because the government was encouraging debt at the same time as it was trying to cut public expenditure. Did you accept that?
I would accept that completely. That was a political judgment that the UK public, it wasn't just the UK, across most G7 jurisdictions, the public didn't have the tolerance for expansionary fiscal policy, and therefore the electorally successful mandate employed twice in the UK, 2010 and again in 2015.
But irresponsible in as much as people were encouraged to borrow.
That's where politics trumps economics, and I'm afraid we are in a phase when the best economic advice going up from the experts, that's become a dirty word, at least in the UK recently, is overruled by what is seen as politically expedient. I would caution by saying I think the dial is shifting. You're starting to see the general public more tolerant of public spending, but it isn't suddenly going to become neo-Keynesian. You said you can't have jargon. You're not going to suddenly see a great expansion of either the welfare state or public sector spending, simply because, as was said earlier, there isn't the envelope actually for most governments to do that, because they've still racked up huge amounts of debt repairing the global economic system.
Come to you for a last word out of Florida. I mean, it's always the little people that suffer if there is some kind of recession, isn't it? And I don't mean that in a patronising way. It's people like us sitting around the table, people who have jobs that they have to go to that are no longer there. It's people who have debts that they've been encouraged to build up that they can't afford to service. Big institutions, by and large, will come out of this okay.
Well, the big institutions did not come out of the financial crisis okay for the most part.
There were still hundreds of thousands of people getting massive bonuses in the banking system.
For the little people, and I would say that as you go down the scale, it got worse. And for those at the bottom, the coming back has been extremely difficult. And we did not see that, for example, with the dot-com bust, because that didn't involve the real estate that was owned by ordinary Americans and ordinary people in Spain and other countries.
So the advice, presumably, from you at this table, Russell, would be to people: do not build up your own personal debt. get as straight as you can because trouble's coming?
I'd say be cautious. I mean, the problem is there's something that economists refer to as the paradox of thrift, which is if everybody saves, you actually end up depressing the economy, and that feeds back into your income, so you earn less. So you've got to be careful. There's a balance. You need a certain amount of debt for an economy to function and to achieve an optimal growth rate. But you don't want too much debt, and you don't want too little debt.
So be careful.
Be careful.
Simple as that. You're going to sell your stocks? Like, Linda, I don't even know if you have any. Very personal question. As Russell says he's going to.
I have some simple advice.
I would agree that I think during a period of low interest rates, you need to essentially sort out how your income growth looks, how much you can afford if interest rates go up, all the very, I think, practical things that you should begin to look at, because obviously every household is different. Students, they take on debt, they earn money later. Pensioners dissave because they're actually consuming out of savings. Yeah. They don't earn income anymore. There's nothing necessarily intrinsically bad about debt. It's always affordability.
Thank you all very, very much indeed for coming on Roundtable. These cycles of boom and bust, well, they have become pretty familiar over the years. Perhaps new economic models could lead, some suggest, to more stability, or maybe it's all part of a greedy capitalist world. I'm David Foster. Thank you very much for watching. See you next time. Bye-bye.